So hi everyone. So we'll be starting with the sample paper one, sample paper for the final exam. It is posted on the UPLearn, so you guys can have access to the sample paper. So we have been given the question number one, that is the current price of the non-dividend paying stock is $30. Over the next 6 months, it is expected that it can rise to $36 or it can fall to $26. So they are being asking us. So they have given it a stock price is $30, right? And they are saying that the stock price can either go up or it can either go down. So it can either go to $36 or it can either go to $26, right? And they have also given it a risk rate is 0. And what they are saying is that what is the risk neutral probability of that stock price will be $36. So they are asking what will be the probability for the stock price going from $30 to $36. So we know that to calculate the risk neutral probabilities, we have this formula. P is equal to e to the power RT minus D upon U minus D. So we know that the stock price can either go to 36 or it can either fall to 26. So here U will be 36 upon 30 and D will be 26 upon 30. Right? So using this we'll be getting 1.2 and 0.8667. So is that clear? Up till the stock price can go to 36 or it can fall to 26, and accordingly we have calculated U and D values, and then we can actually put in the U and D values over here. So what we'll be getting is e to the power R. R we have been given as the risk rate is 0. So it's 0 into time is 6 months, so 6 by 12 minus D is 0.8667, right? And U is 1.2 minus 0.8667. We know anything to the power 0 is 1, right? So it will be 1 minus 0.8667 upon 1.2 minus 0.8667. If you calculate this, you will get as 0.4. So this is the formula for so this is the question number one. So this is the process that you guys need to follow. Any questions with respect to question number one? Okay, so moving forward to question number two. It's been given in a binomial tree created to value function of the stock. The expected return on stock is the binomial tree. What the binomial tree assumes is basically we have to calculate the risk neutral probabilities in such a manner that the return on the risk-free asset should be equal to the risk-free asset return. So what is basically the binomial model state? Binomial model says that risk neutral probabilities should be calculated in such a manner that the return, expected return on risky asset should be equal to the return on the risk-free asset. So this is the basic phenomena backed by binomial model. So that's how we calculate the risk neutral probabilities also over here. And this is the formula. So that's why that's the correct answer for the option for the question number 2 will be in a binomial tree created to value an option on a stock, the expected return on stock will be equal to risk-free asset. Any questions? Moving forward to question number 3. Which of the following describes delta? So you guys should be very much clear with all these option Greeks. So we know that delta is basically the change in the option price with respect to the changes in the stock price. So the correct option will be option number A. The option number C, the ratio of a change in option price to the corresponding change in the stock price. Moving forward to question number 4. Which of the following is assumed by the Black-Scholes model? So we should be aware that for the Black-Scholes model, what they assume is basically the return from the stock, that the stock price at the future term is log normal. If you guys know, we tend to calculate ND1 and D2, right, in Black-Scholes model. So it basically assumes that that a stock price at a future time is a is a log normal. So the correct option will be option number B for the question number 4. Is that clear? For the question number 5, they are asking what does NX denote? Similarly, what they are asking is what does ND1 denotes or what is ND2 denotes. So if we have this X over here, right? So what NX denotes is what is the probability of these deviations. So we know this is minus infinity, this is infinity, right? So the correct option will be the area under normal distribution up to X. So we have to take the area up till X, not beyond X. Is that clear? Yes.
As stock price cannot go below 0, how can we rule out option E?
How can
We rule out option E.
the area under the normal distribution from 0 to X? So if we take 0 over here, right? But the BSM model does is that we have to take the ND1. ND1 is basically the probability that the stock returns will be falling in this region. So there will be maximum deviation of this region. It can't go beyond this.
Right. But the price of option or the stock cannot go below 0, right? So
Yes,
so why not from 0 to
because that's what the Black-Scholes model suggests that if you go to the question number 4, that's what the Black-Scholes model suggests that the return from the stock that a stock price at a future time is log normal. So it's basically normal distribution also is logarithmic of that. So D1 also, if you can remember the formula, is logarithmic of S naught divided by E, that is the exercise price. So that's why we are taking only this much. We are taking the area from infinity to X, not from 0 to X.
Even though you get 0 there is 50%, right?
Yes.
Yeah, well, X equal to 0, yeah,
Yeah.
the distribution is 50%.
Yeah, 50%. And mostly, if we take normal, you can go to statistics, you will get mean over there. So here it's mean, 50% will be there, 50% will be over to that side of the mean. That's how the normal distribution is formed. Moving forward to next question. We have been given that a stock price expected return of 10% per year and has a volatility of 20% per year. What is the expected value of continuously compounded return in 1 year? So you guys can just calculate this question now. There's one formula that you can refer to. So we have been given expected return that is also equal to mu is equal to 0.10, 10%, and we have been given volatility is equal to 20%. Right? So we have been asked what is the expected value of the continuously compounded return in 1 year. Right? So you guys can just do this formula. So there is this formula for calculating the expected value of the continuously compounded return. So it's a continuously values 0.1 volatility is 0.20 divided by 3. So calculating this, you will be getting 0.08 or 8%. I hope this thing is clear. Any questions? Okay, moving forward to question number 7. Which of the following is a way of extending the BSM formula to value a European call option on a stock paying a single dividend? For the Black-Scholes model, we know what the formula is. For the Black-Scholes model, if the dividend is being given, this question was also covered in the homework number 5. So if the dividend is being given, so what we'll do is basically we'll subtract the value of the dividend from the, we'll subtract the present value of the dividend from the stock price and then we'll use the PSM format. We can actually compute the value of the call option and the put option accordingly. So the correct option will be option number D. Subtract the present value of the dividend from the stock price. How can you deduct that? So S naught will become like that. So new S naught will be this. The previous stock price or the current S naught minus. So the level of dividend into e to the power minus R. So this is how you calculate the present value of dividend. This we have used a lot of times, I think in homeworks 2 also, I think when we used to calculate the present value of dividend. So I think you guys keep going. D is basically dividend.
Present value.
Yeah, present value of dividend is basically D e to the power minus R. Moving forward to next question. We have been given that question number 8. When the non-dividend paying stock price is $20, the strike price is $20, the risk-free rate is 6%, the volatility is 20%, the time to maturity is 3 months. Which of the following is the price of the European call option on a stock? So this is the question with respect to the Scholes model. So we know that as per the Scholes model, right? What is we have to actually calculate what is the value of the call option. So C naught is equal to S naught into ND1 minus K e to the power minus RT and D2, right? And we have to actually calculate these values ND1 and D2, right? So for calculation of D1, what is D1? We know that it is logarithmic of S naught upon K plus R plus standard deviation square divided by 2 multiplied by T and divided by volatility. So we have been given all these things in the question. So we have been given the stock price as $20. So we can just put in the value logarithmic of 20 divided by strike price is also 20. So 20 plus R we have been given risk-free rate is 6%. So we'll take the risk-free rate is 0.06 plus volatility we have been given 20%, right? So it will be 0.20, right? Divided by 2. Time we have been given as 3 months, so it will be 3 by 12, that is 0.25, right? Whole divided by volatility is 0.20, time is 0.25.
The point would need a square.
Yeah.
Yeah, you're right.
Is that clear? So if you solve this, you'll get the value for D1 as to be 0.2. And for calculation of D2, we know what is the formula for calculation of D2. It's basically D1 minus standard deviation into root of time. Is it clear? So we'll compute this 0.2 minus volatility is 0.20, time is 0.25. If you calculate this, you will get as 0.1. So putting these values for D1 we got 0.2, D2 we got for D1 we got 0.2, for D2 we got 0.1. So we can put these values over here. So it will be S naught will be 20 into ND1 and to the and in the parenthesis it will be 0.2. So as 20 into n 0.2 minus A to the power minus RT. That's why left with calculate. So we have been given K is 20, right? E to the power R is basically minus 0.06. into 0.25, right? If you calculate this, you will get 19.7. So accordingly, it will be 20 into n.2 minus 19.7 into n.1. So the correct option will be option number B. Is it clear? Clear? Okay. Moving forward to next question. This is question number 9 is with respect to the ESOP, that is employee stock option. So they are given 4 options. So we know that employee stock option it's basically the stock option that has been given to the employees. So they can actually what will be correct answer will be option number B. The ESOP tends to be accessed earlier than a traded option with the same terms. Why it will be accessed earlier? Because they cannot be sold. Because they cannot be sold and accessing them is the only way to monetize the gains. So if they'll not exercise, they'll be losing that value. So that's why exercising it is the only way to monetize the gains because they cannot sell these options in the market. So that's why the correct option will be so the investors, so the employees will be holding this employee stock option plan will tend to access them early. This as compared to the traded option. Because traded option, if you have the traded option, you have the right to access it early or not to access it early because you can sell it option as well. But here you do not have the right to sell, so that's why you tend to access it early than a traded option with the same terms. So the correct option will be option number B. Similarly, question number 10 is also on the employee stock options. So you should be there's one PDF also that is being put on the Learns course document, which is with respect to final exam review. So there are all the pointers which are listed on the employee stock option plans. I think it can be posted by professor. So you guys can actually look into that pointers for the employee stock option plans because all these pointers are very important. Anything can come up for the final exam from the employee stock option plans. So with respect to question number 10, the out of the money employee stock options are usually forfeited, and the in the money stock options are usually accessed immediately. Why they tend to be accessed immediately? I've already told in the last question that it is not advisable to hold it because they cannot be sold, and that's why the employees who are holding the ESOP tend to exercise it early. So the correct option for the question number 10 will be option number B. Question number 11 is also when a CEO has employee stock options, he or she is in theory motivated to do which of the following. So he'll be taking the more risk because he has got the employee stock option plan, which he does not have to actually in the market if the same option is valued at higher price, he has got an option he has got a stock option which might be of lesser cost to him. So that's why what he's motivated to do is to take more risk. Because as they take more risk, the volatility will increase, and as the volatility increases, the option price will also becomes more valuable. Moving forward to question number 12. A call option on the stock has a delta of 0.3. A trader has sold 1,000 options. What position should the trader take to hedge the position? So to deal with this question, I just want to deal with this one thing that is called the delta neutral hedging strategy. So what does this indicate? It indicates if delta is 0.5. So this indicates so there are various different meanings for delta. One meaning for delta is basically if the delta is 0.5, what does it indicate? It indicates that the change in the option price with respect to the changes in the stock price is 0.5. But as per the delta neutral hedging, what does this indicates? If the delta is 0.5, it means you should to make your portfolio delta neutral. What you need to do is basically write. If you are basically writing one call option, you'll have to buy 0.5 share. This is what delta means in delta neutral hedge. So accordingly, we can actually calculate it for the question number 12. For the question number 12, we have been given that a call option on the stock has a delta of 0.3. A trader has sold 1,000 options. So if the trader has sold 1,000 options, it means that he has written 1,000 call options, right? And the delta is now over here it's 0.3, right? So if the delta is 0.3 and the trader has written 1,000 call options, so how many shares should he buy?
300.
Yes. So the answer will be option number B, by 300 shares. Moving forward to question number 13. What does Vega make? So this is also with respect to option weeks. So you should be aware that Vega is basically, I always tend to remember like this, V for Vega and V for volatility. So this is how you can also remember. Vega is basically with respect to the changes in the option price with respect to changes in the volatility. But all the options like the first option, the rate of change of delta with the asset price. What does that indicate? That's gamma. So option weeks I'll go through it again. Delta is with respect to the changes in the option price with respect to changes in the stock price. So how much the value of the option will change with respect to the changes in the stock price? That's what delta is. Then we have gamma. Gamma is basically the changes in the delta. So it is basically an acceleration kind of thing. So the changes in the delta with respect to the changes in the stock price, that is what is basically gamma. So the question number 13 part A will be gamma, the rate of change of delta with its asset price, it's basically gamma. Then option number B, the rate of the change of the portfolio value with the passage of time, that is basically theta. Theta is basically with respect to how much the value of the option will change with respect to the passage of time. Option number C, the sensitivity of the portfolio value to the interest rate changes, that's basically rho. And option number D, so but we have been asked Vega, there was no such option with respect to that the rate of the change in the portfolio value with respect to the volatility, so the option will be D, because they are not given that option. Is that clear with respect to option weeks? You should be very clear with these option weeks. Now moving forward to question number 14, they have given it a portfolio of derivatives on a stock as a delta of 2400 and a gamma of -10. An option on the stock with a delta of 0.5 and a gamma of 0.04 can be traded. What position in the option is necessary to make the portfolio gamma neutral? So they have given delta. Delta they have given 2400. Gamma they have given -10. And they're asking an option also they have given it the stock an option on the stock with a delta of 0.5 and gamma of 0.04 can be traded. So what position in the option can be is necessary to make the portfolio gamma neutral? So we'll assume that X number of contracts have been entered. X number of contracts in option have been entered. X number of options, X number of contracts in the option have been entered to make the portfolio gamma neutral. Accordingly, if the portfolio is gamma neutral, it means that the net gamma will be 0, right? So you want to make the portfolio gamma is equal to 0. But what is the portfolio gamma? Portfolio gamma, you already have a portfolio of derivatives which has a gamma of -10. So you already have -10. Plus you are entering into the X number of contracts. And these X number of option contracts has a delta, has a gamma of 0.04, right? So it will be X into 0.04 is equal to 0. Is that clear? Then ultimately you can calculate 0.04, X is equal to 10. So X will be equal to 250. Since X is positive figure, so what we'll do is basically long. So that's why the correct option will be long position in the 250 option. The option A will be correct. So question number 14. Similarly, if you go to question number 15, it's with respect to the gamma. Which of the following is not true about gamma? So you should be aware that change in portfolio value is equal to, with respect to, if we want to see the gamma effect. This is basically gamma effect. If we have a gamma of something, or if we have a gamma, how much will be the change in the portfolio, right? So half into gamma into change in the stock price. Okay. So this is basically if there is a change in the gamma is basically with respect to the change in the delta with respect to the changes in the stock price, right? So if the stock price changes, what is the gamma effect and how much will the value of the portfolio change with respect to this? That's what this formula is. The change in the portfolio if the stock price changes. And what is the gamma effect on the portfolio? So that's the basic formula that you guys need to be aware of. And now moving forward to the option, we have been given a highly positive or a highly negative value of gamma indicates that a portfolio needs subsequent rebalancing to state delta nu, right? Obviously, if the gamma is positive or if it is negative, right? But it will be indicating that we'll need to make the portfolio neutral, right? So we'll be entering into some number of contracts to make the portfolio neutral, either long or either short. So the option number A is correct. Now moving forward to option number B, the magnitude of the gamma is a measure of curvature of the portfolio value as a function of the underlying asset price, right? So it's basically, I have told you that this is basically the acceleration effect of the delta, right? So it is basically the changes in the delta. So changes in the delta is basically the curvature of portfolio as a function of the underlying asset price. So the option number B is also correct. Option number C, a big positive value for gamma indicates a big movement in the asset price in either direction will lead to a loss. So if gamma is positive, the portfolio will increase or decrease. If gamma is positive, the portfolio will increase or decrease. Increase because the whole value will be positive. This is already square, so it will be positive. Anyways, even if the stock price decreases, it will still be positive. If gamma is positive, and if the gamma is negative, the portfolio will be negative. The portfolio will be declining in its value, right? So that's why they are saying that a big positive value for a gamma indicates a big movement in the asset price. In either direction will lead to a loss. How can it lead to loss? Because if the gamma is positive, it can give you profit. If the gamma is negative, it can give you loss, right? So it can't give you loss in both the situations. So so not correct option about gamma is option number C. So the option C is the answer for question number 15. A long position in either a call or put has a positive gamma. Yeah. So the gamma will always gamma will be a positive if you're entering into long call or long put. Moving forward to question number 16, the delta of the call option on a non-dividend paying stock is 0.4. What is the delta of the corresponding put option? So delta of put is equal to delta of -1. So this is the formula. The delta for the put is equal to delta of the call -1. So we have been given the delta for the call is 0.4 -1. So what we will be getting is -0.6. So the correct option will be option number C. Any questions with respect to any questions done till now? Okay. Moving forward to which of the following is true for a long position in an option. So through this one chart, you guys should be knowing this chart. This chart is very important. Delta right? Question can be any ways. So it can be the long call long put, short call, short put. Question can be asked in any ways. So you guys be knowing if the call is a long call, delta is positive, either positive or negative. What is the delta? Delta is positive or negative. So this is basically it's positive, negative. So this should be here. So that's how the question number 17. Which of the following is true for long position in option? Long position. But we're positive with gamma is positive, vega is positive, rho is positive, and delta is positive if it is long call. And gamma and vega both are positive for both long call and long put. So that's why the correct option will be option number D. Both gamma and vega are positive. If you're entering a long position. Is that clear up till now? So, moving forward to next question. Before I move forward to the next question, I just want to discuss with you guys that with respect to the Black-Scholes model, right? Black-Scholes model, what it assumes is basically the future stock price is basically log normal, right? It assumes that the distribution is a logarithmic of normal distribution, right? So, but the drawback of BSM is basically the BSM assumes that the volatility is historical volatility. So whatever the formula you have for the BSM model is basically it takes into consideration historical volatility. But while but during 1987 market crash, what it was noticed is basically there can be a sudden change in the option prices with respect to the volatility. So we can't take the volatility as to be historical volatility by calculating the value of the call or the put option using Black-Scholes model. So we can't take the historical volatility into consideration. Black-Scholes model fails when there is a sudden changes in the market. So during 1987 market crash, the traders who has actually entered into the contracts using the Black-Scholes model have to actually incur the losses during that period. That effect is also known as cashophobia. So that's why we actually take into consideration implied volatility. So what this implied volatility is basically, as opposed to the historical volatility, implied volatility is basically a proxy of the expensiveness or the cheapness of the option price. So if the implied volatility is higher, it means the option price, it means the option price is expensive, and if the implied volatility is less, it means the option price is lower, right? So this is basically the implied volatility, and using the implied volatility concept, we have this volatility smile also. So we have this implied volatility. This is intrinsic value, and this is the strike price, right? So we have this implied, and we have this volatility smile like this. This is basically volatility smile. So you know that smile shape, we know this is a smile shape. So this graph is also like a smile shape, volatility smile. And what does this indicate? Over here is basically this volatility smile shows that this is the at the money call and put. If the strike price is higher, will you be gaining? Will the call option be in the money or be out of the money? If S naught is greater than K, what is the if S naught is greater than K, the call is in the money or out of the money? In the money, right? And as the strike price increases, the call option will be the K will be higher. K will be higher than the S naught. The call will be out of the money, right? So over to this surface, we have the out of the money call, and over here we have in the money call. as opposed to call, we have this in the money, put over here, and in out of the money, put over here. Is that clear up till here? So we have this volatility smile based on the implied volatility concept, and we have this. So if you have, if you take the same surface, like if you have the same strike price over here, K1, K2. If K1 and K2, for instance, if it is K1 and this is K2. If K1 and K2 are both equidistant from this point, for instance, if this point is O, right? If these are if K1 and K2 are both equidistant from the point O, then the call and the out of the money call will be of the same price as of the out of the money put. So, right, is this clear? At K1 and at K2, right? The in the money call and out of the money call will be same. So they'll be having the same price. So the call and put will be having the same price, because implied volatility, what does implied volatility specifies? It specifies how much expensive the option is. So higher implied volatility, it means higher the option price. So that's why implied volatility is also seen as a proxy of the option price, whether the option is expensive or cheaper. So that's how this concept is. So
I just try to, this one, when the smile is applied for the current, when it's applied for the, as you mentioned that
This
for
is
the
for
stock
equity
options, for the stock option, actually it's like just the go this way.
skewed.
way.
So I was just explaining smile and I come to skewed concept of.
Okay.
Yeah.
Because
So this is
one
volatility smile,
Yeah.
but we also, if this tail is actually to the but this type of situation does not actually appear in the market. So what we normally see is volatility skewed. So if we'll see the volatility skewed, right? So you can have this. So this is basically volatility skewed. So that's how the question number 18 is also based on. So based on this IV, we have this normal distribution in Black-Scholes model. But for normally what we have is also is IV distribution. So we have the implied volatility distribution also, right? And there's one graph that I wanted to draw. One more graph. So this dotted line actually indicates the normal distribution, but this black dotted black line graph shows basically the IV distribution. So this is IV distribution, and this is basically log normal or log normal distribution. So we have the implied volatility, which indicates the expensiveness of the cheapness of the stock of the option price. And then we using the implied volatility concept, we can actually draw this diagram. So we can have the log normal distribution, or we can have the implied volatility distribution, right? So now what they're asking is basically which of the following is true for question number 18. Which of the following is true when the tails of a future stock price distribution are compared with those of log normal distribution. So we are comparing the IV distribution with this log normal distribution, and they are saying with the same mean and the same standard deviation. So you guys can see the left tail is the left tail of the IV distribution is higher than the log normal distribution, right? This one is higher than this, the dotted. So it means that the left tail of the IV distribution is fatter. It's not thinner, it's fatter. And if you see the right tail, it is less. The right tail of the IV distribution is less than the log normal distribution. It means it is thinner, right? So that's why the correct option will be option number C. The right tail is thinner, but the left tail is fatter. Similarly, question number 19 also we have why do traders use volatility smiles? This was a volatility smile, right? So why do traders use volatility smiles for pricing option? Why do they want to use it? Use it because they do not want this log normal distribution. They want this IV distribution. That's why that's why the option number A is correct to allow for log normality of the probability distribution of the future asset price. So that's why the option number A is correct for question number 9. Any question with respect to these concepts or any question on these questions as well? Yes, could you explain the 19 to 9? Yeah, so they are asking why do traders use volatility smiles for pricing options? One of the drawback of the Scholes model was basically it is taking into the account historical volatility, while the implied volatility considers the demand and supply, takes into account the demand and supply for that option price also, and depending on the demand and supply it calculates the volatility. So it is basically, it actually represents the expensiveness or the cheapness of the stock option price, right? So so that's why in Scholes model we have the log normal distribution, but for IV or in volatility smile we use basically the IV distribution concept, and that's why why do the traders use volatility smiles to not use this log normal. So that's why the option A will be there to allow for non-log normality of the probability distribution of the future asset price. Moving forward to question number 20, which of the following is true for European call and European put options? We have been given if they have the same strike price, they have the same implied volatility. If they have the same time to maturity, they have the same implied volatility. So this basically assumes that it's the same time and the same strike price that then they would have the same implied volatility. So the option number C will be correct. Moving forward to the part B. Any question with respect to this MCQ? Okay, moving forward to question number 1 for the part B. It's also based on the binomial tree. So we have been given the consider the one-step binomial tree model. Take U is equal to 2, D is equal to 1/2, I is equal to 10% continuously compounded, T is 1 year, current stock price is 100. So the current stock price is all 100. It can either increase or it can either decrease, right? How much it can increase? It can, U is being given 2, so it can either increase 100 into 2, 200, or it can decrease 100 into 1/2, that is 50, right? Now, what is the probability that the stock price will rise to $200 from 100 to 200? That we need to calculate using a formula, that is e to the power RT minus B upon U minus B. We have been given risk-free rate is basically 0.1, 10%, 0.10 into 1 minus time is 1 year. And then we have been given D is basically half, that is 0.5 divided by U have been given 2 minus 0.5. So accordingly, we can calculate the value for the P. So the value for the P will be 0.4034. The probability that the stock price will rise from $100 to $200 will be 0.4034. And the probability that stock price will fall from $100 to $50 will be 1 minus this. So it will be 0.1 minus 0.4034 is equal to 0.5966. Is that clear to here? Okay. Moving forward to Question number 1, part B. What is the price of the digital option that pays $110 when the final stock price is greater than 120 and 0 otherwise? Right. So if what is the payoff? If the stock price is, if they are saying, if the final stock price, these are the final stock prices, right? The final stock price can be 200 or the final stock price can be 50. Now, if they are saying if the final stock price is greater than 120, if it is greater than 120, that is, if it is 200, then how much are we gaining? It is 110, right?
They don't say it's a call, but we imply it's a call.
They have already given the payoff. So we are not been given whether it is a call option or a put option. We have been given a digital option. So digital option takes into consider. So for the digital option, they've already given what will be the payoff. So they are saying that if the stock price is greater than 120, if it is greater than 120, you will get 110. If it is less than 120, you will get 0. You will get nothing. So if it is less than 120, for instance, if it's 50, then you will get nothing. So the gross payoff will be 0.
This is just because the binomial trade has a lot of flexibility. So if you look at the listing in the market, a lot of payoff for the option are like the two-sided negotiation. So if you look at that one, exactly payoff not exactly like the perfect call option, which is the strike price, so the stock price minus strike price. A lot of time like in the same market, people just negotiation, get some really weird one. So you in the real market, you see a lot of different options. This one called like digital option. There's a lot of other options. I just didn't have time to cover that one. There's something called like look back option, Asia option. So all kind of like payoff is really as dependent. That's why at here we just randomly do some like the payoff. But you know, if you know how to do the binomial trade, it's very easy. You use the binomial trade neutral pricing methodology to get the pricing option pricing. Sorry, go ahead.
So we have calculated gross payoff, right? Accordingly, if the stock price is $200, we have the gross payoff. If the stock price is $200, it is greater than 120, we'll be having the payoff of 110. If the stock price is 50, it is less than 120, we'll be having the gross payoff of 0. So accordingly, we can calculate the value of the option, right? So the price of the option will be. So the price of the option will be. So the price of the option will be 110 we are earning, right? But what is the probability that we'll be earning 110? It's basically 0.4034. What is the probability that we'll be earning $0? It's 0.5966, right? So this is, but the price is taking into the consideration of probability into the expected return, expected gross payoff, right? So it's basically 0.4034 into 110 plus 0 into 0.5966 plus so this is the value, this is the payoff that will be earning. But now you have to calculate the price of the option as of today. So you have to discount it also. So it will be e to the power minus r. So multiply it to be e to the power minus r. This is the normal formula for the binomial. But I just wanted to show you how this formula works. So that's why you will take the gross payoff multiplied by probability, gross payoff multiplied by probability, then you will add this all, and then you will be actually taking the present value of it.
If time is not given, then 1 or t?
If 110 is not given,
Time.
time is given already.
Yeah, time like
Time is 1 year.
1 year. Sorry, I forgot this is something like my prepare the sample exam. I forgot to type in 1 year, and because
It is been given in the question.
Yeah,
It is given.
it's 1 year because it's said like the one step binomial.
No, it is all. It is given t is equal to 1 in the question.
Yeah. I only put into the solution. So sorry about that.
Oh, it's not here, yeah.
Yeah.
Exactly.
I forgot to put it into the sample exam.
Next is the sample exam. Is there.
Yeah, but I only put it into the solution. When I
No,
work on the.
it's not.
It's not there.
It's not here.
Okay, but I can see the you can see the consideration the one step binomial tree.
In question without answer.
Yeah.
Yeah, I give you the solution one. Solution one,
Okay.
when I work on that one, I realized I forgot it.
So in my paper, it's in the question.
He updated the solution.
Yeah, I only give you the.
Okay, no problem.
For the final, you give us time. You give us time for final, right?
Yeah.
So you will calculate this, you will get as 40.15.
This is very similar to the homework four. You worked on something called a power option. So to be honest, this is similar methodology.
One step binomial model is quite simple if you guys think of it as better. So now moving forward to question number 2, it's also into binomial tree model, but it's a two-step model. So we'll be now dealing with the question number 2. So we have question number 2. We have been given, we have to create a binomial tree two-step binomial tree model with u is equal to 1.25 and d is equal to 0.8, with each step representing 3 months. So the total time period is 6 months. So we have to create 2 steps. One will be 3 months and the other one will be 3 months. And the risk-free rate is 10% per annum with continuous compounding. Assume that Uber stock is trading at $40 as per now, right? So it's 40 today. And after 3 months, it can go to, we have been given u is equal to 1.25. So it can be 40 into 1.25 or 40 into 0.8. Right? So if we calculate 40 to 1.25, it will be 50. And it can be 40 to 0.8, it will be 32. This is after 3 months. Right? Now after 3 months, it can either increase 50 into 1.25 or it can decrease from 50 into 0.8. It will be 62.5 or it can be 40. Similarly for 32 also we can do the like this, like in the same manner. 32 it can increase 1.25 or it can decrease. Right? So it will be 40. 25.6. Is that clear up till here? This is quite similar to the question in the homework also. So now they are asking, what is the today's price of a European call option on an Uber stock that matures in 6 months and has a strike price of A is equal to 40. So we have been given this is the call option. So what will be the payoff? It will be S0 minus K, right? And okay, so we can first of all calculate the gross payoff. So we have been given K is equal to 40. So what will be the gross payoff? If the stock price is 62.5, it will be 62.5 minus 40. So it will be 22.5. And if it's 40, the payoff, you will not be exercising the call option. So the payoff will be 0. Similarly, if it is 40 over here, payoff will be 0. If it is 25.6, still the payoff will be 0. Now we also need to calculate the risk neutral probabilities at each step, right? So we can calculate the probabilities using the same formula. P is equal to e to the power RT minus D upon U minus D, right? E to the power RT, R we have been given as 10%. So e to the power 0.10 into time we have been given. It's each step is 3 months. So we'll be taking 3 months, not 6 months. Please remember to not make this mistake. Each step is 3 months, so we'll be taking 3 by 12. So it will be 1.25. 3 by 12 will be 0.25 minus D we have been given 0.8 divided by U we have been given 1.25 minus 0.8. So if you calculate this, you will be getting the value as 0.5007 for the probability. Is that clear over here? So the probability for this, for the rise is 0.5007, and for the fall in the price, it will be 1 minus 0.5007.
When we do the payoffs, we only do that for the last note, right?
No, yeah, we'll calculate it for, we'll move backwards. So every time you are making the binomial to move backward, it will make more sense. So we are calculating the gross payoff for all these prices. Then we'll calculate the stock prices as per this. And then we'll actually calculate the option price over here. I'll show you. This is what is being asked in the question. So what is the value of a European call option in 3 months? And what is the today's price? So they've asked after 3 months, right? Up till this point and today's. So they're asking over here. Option price. So option price over here, today, and then after 3 months. So if we want to calculate it after 3 months, what will be the value of the option? It will be 22.5 multiplied by the probability 0.5007 plus 0 into this probability 1 minus 1 minus 0.5007, right? Similarly, 1 into this probability, 0 into this probability. So then we'll add all these things, and then you will have to actually discount it for 3 months, and then you will reach over here. Is that clear? I'll show you how. So value in 3 months. Value in 3 months will be 22.5 multiplied by 0.5007 plus 0 into this plus 0 into this plus 0 into this probability. But everything will be 0, so I am not writing over here. Multiplied by e to the power minus RT, we have to discount it and bring it these gross payoffs to this point. Right? So it will be minus 0.10 into 0.25. Right? So accordingly, you can get the value after 3 months. It is 11.9876. So this 11.9876, you have got the value after 3 months. Now you have to calculate the value for today, right? So doing this, you have reached up till here, and here the value is 11.9876 if the price is $50, and the probability that the price will be $50 is basically 0.5007. So ultimately multiply this to 0.5007 and then discount it back to calculate the value for today.
Can you check? I think it's a 10.9876.
Yes.
Thank you.
And then you have to 10.9876 into e to the power minus 0.10 into 0.25
And you also need
into multiply by probability, that is 0.5007. And if you do this, you will get the value as 5.3656. Is this clear up till here? These values can't be zero in the question given in the exam. So be clear. You need to take into account each and every value. If it is
This
not,
only happens because at 32 is 0 too, right? The price of the option at 32 is 0.
the price of the,
Option at 32 is 0.
yes. Because there is no the value of the option, only we are getting the value of the option for this. For 32 is 0. So the value for 3 months it's basically over here. So 51. Because the only effect is basically due to this. There's no effect for this. But it's all 0.
If you're calculating it for today, why didn't you use 6/12 the time?
3, 6.
6/12.
Because we have already reached over here. This each step is 3 months. So this is 3 months, then this is 3 months. So 11.9876 until here. And then afterward we have to calculate 5.3656. Then we have to this time period is also 3 months. So you are going from this to this, then this to this.
How did you get the 22.5?
It's basically S naught minus C. So S naught is basically 62.5 and K is 40. The payoff formula, just the payoff formula. The question can for put also. So accordingly, the payoff formulas will be changed. So you guys should be aware of all the payoff formulas. So that's the question number 2, part A. Now moving forward to question number 2, part B.
Where you get the 0.5007?
The probability, the risk neutral probability for the price going upwards.
Why you multiplying it in this practice? Left.
What's the question?
What?
Same question. Why we are multiplying it by 0.507? Because the probability for the price of the stock going up from 50 to 62.5 is 0.5007, and the gross payoff in that situation is 22.5. So to calculate the value of the option, we have to multiply the gross payoff multiplied by the probability for this situation. This situation probability is 0.5007. So that's why we multiply 0.5007 multiplied by 22.5.
It didn't add the going down, because going down the probability, the payoff is 0. 0 times the point whatever, 1 minus 0.557 is still 0. That's why he ignored the other part. Otherwise, should be expect value going up times the probability.
So you
going
can
up.
actually add all these values over there.
Yeah, yeah.
There are values. That's what I'm saying. You there's one question. I think this one the 2 to 3 questions for this is homework 4. So you can go through all these questions. So you do better clarity. There's a question on put also. You know.
The reason is because the payoff going down or 0. That's why I make the calculation so simple.
Yeah.
Is this the same as finding the value on node A per se?
Yeah. In the homework, I told you that you can go by node wise. So it can be node A, node B, node C, then node D, E, F, G. So you can go node wise also.
Yeah, and F all can always combine together because
Yeah.
if it go up, go down, and go down, go up, you always will think that.
Yeah, it's always the same value. But yeah, if you want to combine, it's also you're all good to go. But if you want to show it separately, you're also good to go. In both ways, it's fine. I mean, it gives more clarity because if you have a payoff over here and payoff over here, both of these payoffs will be different. Both of these payoff will be same, but the probability will be different. That's why I normally take it different. Because the probability over here and probability over here is different. That's why I normally write it different. So to get better care.
I'm confused too, why if the option, the European call option matures in 6 months, why aren't we using that for the pricing in every node?
We
It
have
seems like
we have
we-
done the pricing for, okay, I'll go node wise now. We are pricing for every node. So for node D, the payoff will be 22.5. For node E, the payoff will be 0. For node F, the payoff will be 0. For node G, the payoff will be 0. Right? And then I'll calculate the payoff for node B and node C. Right? The payoff for the node B will be this 10.9876, and for node C it will be 0. Because anything multiplied by 0 will be 0, right? So for node C it will be 0. And ultimately we'll have to calculate for node A. So value of today is basically node A, and value of after 3 months it's basically both, it's basically a combination of B and C.
And the T that we use as time is first step. In this case, 3/12, instead of the 6 months
Yes.
maturity date. of the
Yeah,
option.
because they have given that each step is represented by 3 months. With each step representing 3 months. Even if it's not given, it's always assumed to be equal proportion. If it is not in equal proportion, it will be given in the question.
So we can assume that it's equal if nothing is
If
given.
nothing is given, otherwise it will be mentioned in the question. I think there will be no question as such set there, where it will not be specified.
Oh,
Any questions? Okay. Moving forward to compute the question number 2, part B. Compute the dynamic replicating portfolio. Example: how many shares of stock do you have to buy, and how much money do you have to borrow to replicate the value or the payoff of the call at each node? So they are actually asking us how many shares do we need to hold And for holding the shares, we need to actually buy those shares. And for buy those shares, we'll have to actually incur certain sum of money. And if we do not have that sum of money, we'll have to borrow. Right? So that's what they're asking at each note, how many shares of the stock do you need to hold? So for calculating this, I mentioned somewhere in the MCQs with respect to delta. If delta is 0.5, what does this indicate? We'll have to buy, you have to write one share or one option buy 0.5 share.
You're always
Right.
long on the options, right? I mean, on the shares,
Yes,
and I mean, you know.
it's basically a strategy to create a delta neutral hedging strategy. So to create a delta neutral hedging strategy, if a delta is 0.5, you'll have to write one call option or one option, and you have to buy 0.5 share. So accordingly, using this concept, we can actually calculate how many shares do we need to hold. So for this, we'll actually calculate the delta. Right? So for node over here, 62.5, right? Now the stock price is rising from 40 to 62.5. The price is moving from 40 to 62.5. And the option payoff is increasing from 0 to from here the option is 0, the payoff is 0, and over here because here the strike price is K, the payoff over here will be 0, right? So we are moving from 40 to 62.5, and the payoff is 22.5 over here, right? And what delta indicates is it's basically change in option price with respect to change in stock price. What is the change in the option price? It's 22.5. Over here it is 0 because K is equal to 40, right? So it will be 22.5 minus 0. And change in the stock price is basically 40 to 62.5, right? So it will be 62.5 minus 40. If you calculate, you will get the delta x 1. What does delta 1 represent? That you will need to buy one share at what timing? At what time you are buying one share? 6 months, right? So this is basically a time T is equal to 6 months.
No.
You need to buy over here for 3 months.
It's 3 months. Yeah, that's right. Yeah, that's 3 months.
Because stock price is moving from 40 to 62.5, and ultimately you're calculating gross payoff as of over here after 3 months. Is that clear or not?
No,
What is the question?
why are we doing it at node B and not node C?
Node,
See, delta is 1, right? So we will buy the share
yes,
after 6 months, not 3 months. Why
after
would
3
I-
months.
Why?
Because delta is the change in the option price to the change in the stock price, right? And the option price is basically gross payoff, which is basically 22.5, and the stock price is moving from 40 to 62.5.
It's become 2.5 only after 6 months, right? Yeah.
Yeah,
Moving from 40.
sorry. To be honest, like, we should calculate, this is the payoff for this value, the 22.5. This is
Yes.
the option value change, divided by stock price change. Stock price change here is 22.5, and the option value for the offer is 22.5, and this line here. So this two, you calculate the delta C divided by delta S, and then give you the delta X here.
So it's this 3 months. This is T is equal to 0. This is T is equal to 3. This is T is equal to 6. So I was, I think, maybe telling wrong. So at T is equal to 3, you have to actually calculate what the delta is. So at T is equal to 3, but the delta is for if the stock price is and at t is equal to 3, we know that the stock price can either move 62.5 or it can fall to 40. So that's why, but what can the delta be? It can be the change in stock price can be 62.5 minus 40, and the payoff accordingly will be the option price will be accordingly will be 22.5 minus 0. So that's why it's basically delta 1, and delta 1 will be indicate that you have to buy or hold one share. Similarly, you can calculate for this node C. So it will be 40 minus 25.6. Sorry, the payoff will be 0 minus 0, right?
Yeah, that's right.
No, sorry, the payoff will be 0 minus 0.
Yeah.
0 minus 0 divided by 40 minus 25.6.
You.
So this is basically delta at node B. Node B. And this will be the delta will be 0 on node C. And this basically delta is 0, it means you do not need to buy any share. So you'll be buying you'll be holding 0 share. Right? Now this is up till t is equal to 3. Now when t is equal to 0. So what we'll do when t is equal to 0, you will ultimately calculate the value of the delta over here as well. So what will be delta over at t is equal to 0? Delta will be the change in the option price. Over here, what is the option price? The option price we have calculated as 10.9876, right? So 10.9876 minus 0, right? And the share price what we're moving is basically 50 or 32, right? So it will be 50 minus 32. Change in the stock price, right? So the delta will be 0.61. So it means that you need to buy or hold 0.61 share. So we have actually calculated delta for t is equal to 3, for delta t is equal to 0.
0.61 shares to buy.
Yes, because delta
Possible to want B, should be B number.
Okay,
If the screen can be with that side on it.
the monitor right here.
I think because it's also recording.
Oh, it's recording.
Oh, I'm sorry, but I can't see.
Okay, I'll try to write it upwards only. Or I'll write over.
Yeah, please write it.
Don't worry, I already posted the solution in the UB Learn, so all this kind of thing are already in the solution. So you don't need to write down everything. You just listen and understand. You don't need to write them.
At node C, delta is 0. That means you don't have to do nothing to your portfolio.
No, delta 0. If you look at when T0, you hold 0.61 share, but it moved to the price can either move up or move down. If move up, means that you need to hold 1 share. And in that case, you need to increase your share from 0.61 to 1 share. So that's why you need to buy additional share. But it moved to the node C, which is the when stock price dropped to 32. Right now, delta is equal to 0. When delta equal to 0, you don't need to hold any share. That's why you sell 0.65 share. That's the delta hedge.
Or you will sell at 0.61.
Yeah, because you need to clean your current position. It's not like you don't do anything.
It's very dynamic. I mean, dynamic hedging, right?
Yeah,
You have to
dynamic.
do
This
buy,
is
sell,
dynamic hedging we talked in the class.
buy the shares or sell the shares to dynamic.
Yeah, based on the price move. That's the whole purpose for this question is to ask the dynamic hedge.
And then they're asking how many shares of stock do you need to buy? We have already calculated 1 share, 0 share at 1 share at node B, node C at t is equal to 3, we can hold either 1 or 0. At t is equal to 0, we have to hold 0.61 shares. And for buying the shares, we'll have to actually incur some of the money, right? And for increasing some of the money, we have to actually borrow because if we do not have the money, we have to borrow. That's what they're asking. How much money do you have to borrow to replicate the value of the payoff or the payoff of the call at each node. So over here, how much you will be incurring? 0.61 share, and what is this share price at t is equal to 0? It's 40, right? So it will be 0.61 multiplied by 40. So that's basically the upfront cost that you will be incurring, and at time is equal to t is equal to 3. How much will be how much is the price? It's 50. So 1 into 50, and over
No,
here.
it's just additional. It's 1 minus.
Yeah, so you are already holding 0.61 share at t is equal to 0. But how much additional share you will have to buy? It will be 1 minus 0.61 share. Are you guys getting or not? So 1 minus 0.61 multiplied by what is stock price? It's 50. So 1 minus 0.61 into $50, and at node is equal to 0. At node is equal to C. So you have the stocks that you should hold is basically 0, right? So what you need to borrow? You do not need to borrow anything, because ultimately you do not need any shares, so you'll be selling the shares. So how much shares will be selling? 0.61 shares, right? So 0.61 into 32. So that will be negative.
Should we found the delta for t over time 3 and t0, right?
Yeah.
What about t6? We don't have to find out.
No, because they are asking us to actually calculate the because we have to actually replicate the portfolio, right? So once we're done with the gross payoff, we'll just take the gross payoff into consideration while calculating the delta over here. If we want to calculate the delta over here, we need the gross payoffs in the third step model.
Okay, got it.
Oh,
Yes.
Also, at node B, the value of the option is same as the gross payoff.
The value of the option, yes. The value of the option is the gross payoff. So at node B, the value of the option is 22.5. That is the gross payoff.
And then at node B, why isn't it the same gross?
At node B we have calculated over here. It will be 10.9876. It is not same.
It's European option, but even you think about it, the American option at that time, the payoff because the strike price is 40. So 50 minus 40 is American option, that the value is 10, right? But you know that if you, in this case, if you hold another 3 months, you know that you will get a higher expected return, which is 10.98. So in that case, of course, you will not early exit at 50, but here, because we talk about European option, so you just assume the payoff, you will hold on till 6 months.
this is with the pricing, but the setup of the portfolio happened at 8 when you set up the portfolio, right? So shouldn't be delta at 8 equal to 0
Delta
at 8.
At?
At node 8.
okay, node A should be 0.
Yeah, I mean, you're setting the portfolio at 0, right?
Yeah, at time t is equal to 0. What is the formula for delta? The formula for delta is basically the change in the option price with respect to the change in the stock price. So the stock price can either increase to 50 or it can either increase to 32. So what is the difference? Change in the option price is basically 50 minus 32. So 50 minus 32 we have taken. Sorry, we have to actually assume we have to actually take the payoff into consideration. The option value is not 50 or 32. The option value is basically 10.9876 minus 0, and stock price is 50 minus 32. Changes in stock price 50 minus 32, but the option price is changing 10.9876, and over here it's 0. So it's 10.9876 minus 0.
Can you explain the costs that we incur? You said 0.61 into 40, is it? 0.61 share is what we will buy.
First of all, we'll need to buy, yes. First of all, we'll need to buy 0.61 share at t is equal to 0. We need 0.61 share, and the price of the share is 40. So 0.61 into 40 will be the cost at node E at t is equal to 0. And when we're moving forward to at t is equal to 3, the delta is either 1 or it can be either 0, right? It means we need either 1 share, we need either 0 share. We are already having 0.61 share in our portfolio, right? How much more share do we need? 1 minus 0.61. And how much is the stock price? Over there it's 50. So 1 minus 0.61 into 50, that will be the boarding cost of a share.
At T3.
And yeah, T3 there can be two situations, right? And if it is 0, So ultimately we'll have to sell 0.61 share, right? And selling the 0.61 share will sell at 32. So it will be negative for us. So actually we are not actually borrowing, we are actually gaining the cash.
Selling at how much?
Selling at 32.
Selling at 30.
0 in yeah.
What is the
Minus.
zero delta? What is it signify?
It basically means that there is no change in the option price. So you can see that if the stock price changes from 25.6 to 40, right? There is no change in the option price. And if the delta is 0, what does it indicate? It basically we do not need to buy any share because that is already neutral. This strategy is basically to create a delta neutral hedging strategy. That is already 0. It is already we are yeah. Any questions? Moving forward to question number 6. Question number 2 part C. Right. If the 6-month European call option with a strike price of A is equal to 40, so the strike price in this question was 40 only, right? Is trading at $5. So we have calculated the value of the option as of today. What is the value of the option as of today?
5.3656.
This is after 3 months. This is today. It is 5.3656, right? But it is currently trading at $5. So it means that what are we doing is basically we are actually if the value of the option is 5.3656, right? But it is currently trading at $5, it means it is cheaper in the market.
Yeah.
So if it is cheaper in the market, what do we need to do? We will be buying the European call, and if we are buying the European call, now it will be opposite to this. If we are buying the European call, if we are buying the call, what we'll do is basically we'll sell the share. This is what they're asking is basically how can you please specify your arbitrage portfolio, what you should do to make a risk-free arbitrage profit. So that's what they're asking. So at T is equal to 0. What will we do is basically we want to buy the call and sell the share, right? How many shares will we be selling? 0.61, right? So we'll be selling 0.61 shares at T is equal to 0, and at T is equal to 3. What will we be doing is basically we'll be selling 1 minus 0.61 shares, right? And over here we'll be actually buying the right. So this is so actually over here will be so at T is equal to 0, we have delta is 0.61, and what we want is now to sell the share because we are buying the call, right? So if we are selling the shares at T is equal to 0, how many shares will sell? 0.61 shares, and at T is equal to 3, what we'll do is basically we'll be buying we'll be selling 1 minus 0.61 shares, and over here we'll be actually liquidating all the positions.
You meant T equals to?
T is
No,
equal to
3,
3.
3. Okay.
How did we come to the conclusion that it's a buy call?
Because the value of the call is being the current price at which the call is trading it's $5, and the value that we have calculated is 5.3656. So it's cheaper in the market. So if it's cheaper in the market, we will be buying the call. And if we are buying the call to create a delta neutral hedging strategy, we need to sell the share. Is that clear up to here?
Can you repeat what happened at node B again?
At at T is equal to 3. So 0.61 into 0.61 shares will be actually selling it off, right? And over here, how many more shares we need to sell? It's the total number of shares that we need to sell is 1. So we'll be selling more 1 minus 0.61 shares addition that will be selling, right? And over here it's basically 0, right? So we do not want any share and we do not want anything. So we'll be liquidating all the positions.
That is the arbitrage trade, liquidating.
Yes. So they have asked at U node and at D node. So at U node or D node at T is equal to 0, T is equal to 3. That's basically different. It's the same process. Any questions? Moving forward to next question. Moving on to the next question, we have been given, with this question is with respect to the option week. So we have been given delta, gamma, theta, vega and rho, and also we have been given after holding your portfolio for a week, you find that the, price changes from $50 to 51. The rate continuously compounded interest rate changes from 4.75 to 5. Stock volatility changed from 25% to 23%. What is the change in the market value of your portfolio? So we have this Taylor series expansion. Which specifies that a change in the portfolio is equal to delta into change in S plus for the gamma I have told you already in one of the MCQs also, it's basically half gamma into change in stock plus square, and then we have vega. Vega is basically with respect to volatility, so we'll be multiplying it with volatility. Then we have rho. Rho is basically with respect to interest rate. So we'll take the interest rate, change in interest rate square, plus we have the theta. Theta is with respect to time. So theta into change in time. Now we have been given delta. We have been given delta is 50,000, right? Change in S. Stock price is increasing from 50 to 51, right? So it's 51 minus 50 plus half gamma. What we have been given is minus 5,000 into change in S will be 51 minus 50 to the power whole square plus vega we have been given as minus 300,000 into volatility. So we have been given the volatility has to be 25. So the change in the volatility is 25% to 23%, right? So the change in the volatility is 23% minus 25%. Right? And then we have rho. Rho we have been given as 400,000. And the interest rate changes from 4.75 to 5. So it will be 5 minus 5% minus 4.75% to the power square plus theta we have been given as minus 500,000 into change in time. Time is changing from 1. We are actually calculating after holding your portfolio for a week. So that change in the time is basically after 1 week. And how many weeks are there in a year? It's 52. So the change in the time will be 1 by 52. So if you
For the rule, there is no square there. I think like you put a 5%, the 5% minus the 4.75, there's no square. Yeah, okay.
it's only change in the square will be over here only.
Only square, only gamma has
Gamma.
square. Everything else is linear.
Everything is basically changed.
Yeah.
Because gamma is the change in the delta. So we are actually taking the derivative of this also. So if you will calculate this, you will get the change in this. It will be 50,000. 50,000 into 1 will be 50,000. If you calculate this, you will get as minus 2,500. If you will calculate this, you will get as 6,000. If we calculate this, it will be 0.25% into 400,000. So you will get ultimately 1,000. Plus, if you calculate this, it will be minus 500,000 into 152. It will be minus 9615. So solving this, ultimately you will get the values. Uh, 44,885. The change in the The portfolio value will be actually changing by 44,885 with respect to all these effects into the with respect to all by taking into consideration all these beats. Is that clear? Moving forward to question number 4. So we have this question number 4. What option pricing biases are likely to be observed when both tails of stock price distribution are thinner than those of the log normal distribution? So okay, we have the diagram over here only. Right. So we discussed this that Black-Scholes model takes into consideration normal distribution, but we want the IV distribution because it's more relative in nature and it takes into consideration the supply and demand effect and it ascertains the expensiveness or the cheapness of the options. So we have been given both the tails of the stock price distribution are. This is the normal diagram, right? But they have given two cases over here. So if we'll go to question number 4 part A, they are saying that both the tails of the stock price distribution are thinner than those of the log normal distribution. So this is also thinner and this one is also thin. It means it is also like it is also lying like this. So it's also less than the log normal distribution if it is thinner. So if it is less than this. Over here. So we have this diagram. So they are saying that but both the tails are thinner, right? If both the tails are thinner, what does this mean? That the implied volatility is less, right? If the implied volatility is less, the option price is cheaper, it is less, right? But so that's what but Black-Scholes model will tend to overprice it. That's why the first the answer to the first question will be if both the tails of the stock price distribution are thinner. But should be the ideal situation, the prices should be smaller, the price should be less than the Black-Scholes model. The prices are less, but the Black-Scholes model is basically overpricing it. So that's why the answer will be the Black-Scholes model is basically tend to overpricing the options. And moving forward to question number 4 part B, we have the right tail is thinner. So the right tail is thinner. The left tail is better, so it's the normal one. So then now they're asking, so but is basically it's asking is if it is flatter, right? If this is better, so what will this be doing? It's basically higher, but Black-Scholes model is basically cheaper, but it is basically underpriced, right? So Black-Scholes model is basically underpricing. But it is underpricing, it's basically in the money call and out of the money put options. And over here, we'll be having thinner. Say we have thinner, so it will be tend to overprice in the money put and out of the money call. I'll explain this. So we have this stock price over here, strike price over here, and implied volatility or the volatility we have over here. Right, quantity, or you can say the price, right? And then if the strike price increases, will the call be in the money or out of the money? If what is the payoff for the call? It is S0 minus K. So if S0 is greater than K, we'll be generating a positive payoff for the call option, right? And the option will be in the money, right? If S0 is greater than K. But if the K will be increasing so much in the amount that it is exceeding the S0, it means that the call option is out of the money, and out of the money also deep out of the money. So here we have the out of the money call and in the money put. Opposite will work for put. And over here we have the in the money call because K is less and S0 will be higher, right? So we will have the in the money call and out of the money put over here. So for example, we take this as K1 and this we take as K2. Right, so that's what they're asking. if the right tail is thinner, for the question number 4 part B, the right tail is thinner. If the right tail is thinner, the right tail is thinner. What does this means? Right tail is thinner, it means it is less than the Black-Scholes model. Right? If this is less than the Black-Scholes model, it means Black-Scholes model is basically overpricing. But what it is overpricing? It is overpricing out of the money call and in the money put. And over here, it is Black-Scholes model tends to underprice. But it tends to underprice in the money call and out of the money put. Any question?
In the money call, out of the money put, out of the money.
On the x-axis, we take it as strike price. And for the call option, what is the payoff? S naught minus K. And when is the what are the formulas for in the money, at the money, out of the money? When is the call in the money? If S naught is greater than K, and out of the money, if it is S naught is less than K, it means as the K naught will increase, the call there are more chances for the call to go out of the money, right? So if the K will increase to such an extent, here the calls will be out of the money call, and here the calls will be in the money call, and opposite will work for put.
When you say thinner, you mean compared to the log normal or like getting close to the
Thinner, yeah.
normal?
Thinner we say as compared to log normal. Thinner it means it is lying below the log normal. And if it is fatter, it means it's lying above the points. If it is over the left tail, it is fatter. So it means it is lying above the log normal distribution. That is log normal distribution is DSM1. That's what one.
We always compare it with the IV. So when it's
Yeah,
the
because
IV,
IV is basically taking into account the supply and demand effects, and after 1987 market crash, the traders have realized that Black-Scholes model will not work in such a scenario because it takes into account the historical volatility, but in hybrid implied volatility takes into account the implied volatility. Any question? Thank you for patiently listening to me, and all the best for your exam.
Thank you.
The question would be similar to this sample. Probably one or two more, I guess, because I gave you 3 hours compared with if you remember the exam